We're going to continue now with Chapter 11, and we're going to talk about the components that make up the return of a stock, as well as risk, specifically systematic risk and unsystematic risk. So where does the return of a stock come from? When news is released, when a company comes out with an announcement, there are going to be two components to announcements or news. One is going to be the expected news. That's what investors are expecting to hear. And the other component is going to be a surprise, something whether it's good or bad. Now, when investors hear expected news, the stock is really not going to react that much because that particular news is already discounted into the price of the stock. So if investors expect, let's say Walmart, to increase sales, same-store sales year over year by 2%, and Walmart comes out with a press release saying that same-store sales have increased by 2%, well, that information is already kind of built into the stock, and that's called it's discounted into the stock. But let's say Walmart comes out and they announce that sales declined by 1%. Well, that would be a surprise, and that would most likely move the stock in a negative manner. Or let's say you have a company that comes out with a press release that company X has announced that they are going to buy company Y at a big premium. Well, company Y's stock is going to soar. So it's the surprise component of announcements or news that will have a big impact on stock prices and therefore impact the return of the stock. So essentially, there are going to be two components that impact the return of the stock. There's going to be the expected return, and we already learned that won't really impact the price of the stock that much, and the unexpected return. So total return will equal expected return plus unexpected return. And it's going to be the unexpected return. It's going to be the surprises, the things that we didn't anticipate that really move the price of the stock. And now we have to figure out what are the components that make up the unexpected return. And there are two components that make up an unexpected return. There's the systematic portion and the unsystematic portion. The systematic portion, or the systematic risk, or sometimes the reward, is going to be some kind of announcement or something that happens that impacts basically the entire economy, or just about every stock, or a very large number of assets. For example, if the Federal Reserve came out and announced that they're going to increase interest rates, and the market wasn't expecting that, that would have an impact on just about every stock out there. Or let's say something happened with the supply of oil. There was a supply shock to the price of oil. Oil might skyrocket. That would be something that was not anticipated by the market and would impact just about every stock. So stocks would decline in something like that. So systematic risk is also called non-diversifiable risk because basically you can't avoid it. You can't get rid of it. If something happens that's a systematic event, it's going to affect every stock out there. It's also called market risk because it impacts the entire market. Here is an example from just yesterday. Mario Draghi, president of the European Central Bank, announced that Europe wasn't doing enough to fight deflation. So the markets took that, and that was a surprise announcement. The markets took that to mean that the ECB would come out and be more aggressive in buying assets, in having a easy money policy. So the markets jumped by about 2% this morning based on that news from last night. So that would be an example of a systematic event. Now, unsystematic risk, or an unsystematic event, also called diversifiable risk, would be something that impacts a specific industry or something that might only impact just one company. It's something that will not impact the entire economy, just maybe one specific company. So if a company reports bad sales, that would impact, company X. It wouldn't impact the entire market. Unsystematic risk is also called unique risk or asset-specific risk. Now let's talk about diversification. You can eliminate, or pretty much eliminate, most unsystematic risk if you put together a diversified portfolio. And what we mean by that is if you put together a collection of different assets, or let's say different stocks, maybe 20 or so, and they're all in different industries, and they don't all move together, they're not perfectly correlated, you will pretty much reduce and get rid of the unsystematic risk. And the theory behind that is that if company X, let's say it's a pharmaceutical company, and they're doing really well, and they come out with a surprise announcement that sales are a little bit better than normal, the stock will move up. But on the other hand, let's say you own a technology company and computer sales have been down. Well, a surprise announcement there might move those companies down in price. So if you have a diversified portfolio, these kind of surprise announcements that are unsystematic in nature, that are company specific in nature, will tend to offset each other. So by diversifying, you can pretty much eliminate your unsystematic risk and just leave the systematic risk. And here's an example. You have a portfolio of just one stock. The average annual standard deviation would be about 49%. You increase the portfolio up to 10 stocks, and look how much the standard deviation declines. It's all the way down to 24%. If you get into the 20 to 30 area, you're right around 21%. After that, you don't get that, the benefits don't increase by that much. So basically, by putting together a diversified portfolio, you're getting rid of all of this high standard deviation. And what you're going to be left with is just systematic risk. That's why it's important to have a diversified portfolio. Here it is in graphic format, and the pink area represents diversifiable risk or unsystematic risk, and the blue area represents non-diversifiable risk or systemic risk. So, you get 10 stocks in the portfolio, you go up to 20, you're in this 25 area, you've pretty much eliminated most of the unsystematic or diversifiable risk, and what you're left with is the non-diversifiable risk. So if you have a diversified portfolio, you've gotten rid of the unsystematic risk, so now all you're left with is the systematic risk. So we wrote it here, the total risk for a diversified portfolio is essentially equivalent to the systematic risk. You've eliminated the unsystematic risk just by putting together a diversified portfolio. So we have a diversified portfolio at this point, and we have eliminated the unsystematic risk. What is left now is the systematic risk. So what does that mean for the securities that make up our portfolio? Does that mean they're all going to move together and go up and down by the same exact amount? No. Different securities are going to move up or down based upon how sensitive they are to the level of systematic risk. And a way to measure that is called beta. So beta will tell us how much systematic risk a particular asset has relative to the average assets. So if a stock has a large beta, it's going to move up by a greater percentage if the market moves up, and if the market goes down because of some kind of systematic event, in theory this stock should move down by more. And a company with a lower beta would not move as much. So if beta equals 1.0, that means the stock has average risk, and it would kind of move the same amount as the overall market. So if the S&P 500 goes up by 1%, the stock with a beta of 1.0 would go up by 1%. If the beta is greater than 1.0, the stock is riskier than average. That means the stock would go up or down greater than the market. And if the stock is less than 1.0, it means it's less risky than average, and that means the stock would go down by less than the market. Now, of course, beta is based on what's happened in the past. There's no guarantee that's going to happen in the future, so understand that. Now we have a collection of stocks, and of course we're going to want to figure out what's the beta of the overall portfolio. So the formula is similar to formulas you've seen in the past. You're simply going to take the weight of a particular stock and then multiply times the beta of that stock, and then you'll sum them all up, and that will give you the portfolio beta. So let's do a quick quiz to kind of recap some of what we went over. We have security C with a standard deviation of 20% and security K with a standard deviation of 30%. So which of those two stocks would have more total risk? And the answer would be security K, because standard deviation measures total risk of an individual company, and so 30% is greater than 20%, so K would have more total risk. Which security has more systematic risk? And also, which security should have the higher expected return? Well, beta would measure that. Beta is going to measure how sensitive the company is to systematic events. So because security C has a higher beta than security K, the answer would be security C for both of the last two questions. So that would be a wrap for this section of Chapter 11. I'm going to do one more video on Chapter 11, which will come out in a day or two. If you have any questions, as always, just contact me. Have a great day.